it all comes down to supply and demand, to crash prices. There's still enough people, and with government programs to make getting into a house easier. And I think there's going to be more of those programs. So yes, prices are higher, but if you can get in with no down payment, like you can in a USDA loan, or 3.5% like FHA, and incentives for first-time home buyers to give you down payment assistance, et cetera, I think you're going to kind of allow people to get into homes, even if interest rates don't fall substantially, with less money down, which is going to help some people.
All righty, folks, we are going to go through the school community. We're going to read some comments and questions. We're going to have the one and only Anna Kelly and I just riff on them. Again, if you haven't joined school yet, I don't know what you're doing. It's 67 cents a day. Yes, 67 cents a day, $20 a month. Anna, how you doing?
I am great. It's great to be here. I cannot believe it is December and 6 years that we've been doing this together. Yeah, so I noticed amazing. That this month is 6 years.
Yeah, six years. We've been through so much. When we first started doing this, you were still working, by goodness.
I was. It's crazy. And I was excited, and yet all of a sudden scared to death to quit my job that I worked so hard to work myself out of, building one rental at a time. And so, wow, it's been an amazing ride.
There you go. Well, let's start off with a question or a comment from Nicholas. Again, I don't read last names, so we keep everybody private, but this is for Nicholas. He's new here. He just joined yesterday. He's trying to figure out how I can get into real estate investing, owning a rental property, looking to connect and get advice. I recently moved to a different state for family reasons, but sold and made a little money, paid off some debts, bought a new build, wish I joined this community sooner. So Anna, you just moved to a new area, a new state. You caught the bug. What is some early advice for Nicholas?
Well, first, I would have said the house hack, but he just bought a brand new house, right? So house hacking isn't going to be the best thing for him at this point. However, he could consider, depending on, lots of situations, still maybe renting that house and then going to house hack something else. Could be a good idea. But generally speaking, the first thing that I would say when you've moved to a new area is really start studying your local market, especially if you've never bought a property before, because it is generally best and easiest to start in your own backyard, because you can spend time that isn't a lot of extra time, especially if you've got a demanding job or whatnot. You can drive around and get to know a neighborhood. It's really difficult to do that from afar. It's not impossible. I'm big on long distance investing if investing in your backyard isn't lucrative or it's not a good market to be in. But what I would do first is I would say, look at the actual town you're in, and anything within about 45 minutes, maybe an hour, depending on how rural you are and how many small towns there are in between. But I would start looking at multi-units, because even though I love single family for lots of different reasons, right now, single family prices throughout most of the country are not going to cash flow. So if you're looking to invest for any kind of cash flow, you're going to do better owning a multi-unit. So if you're just saying, hey, I want some appreciation for the long term, a single will be fine, as long as you're making more in mortgage pay down than you are your negative cash flow. I don't want you to bank on appreciation, because we just don't know where the market's going to go at this point. So multi-units. Now that you have multi-units, you can go on realtor.com or Zillow and look at sold listings. I like to look at sold listings because it tells me what things actually traded for before I start looking at what's on the market. And what I did, and what I recommend to my coaching students, is start with a spreadsheet, right? Go like pen and paper. You start with a spreadsheet and you document every single multi-unit that's similar to what you're interested in that's sold in the last year. And you put in how many units was it? What was the purchase price? You're not going to necessarily see a cap rate, but you might have data in that listing that shows you, hey, this property, the rents are $4,000 a month. Then that kind of tells you $4,000 a month, sold at $400,000. You have an idea of that 1% rule. So start the spreadsheet. put things in there like, is it updated or does it need $100,000 worth of work? Do the tenants pay the utilities or does the landlord pay utilities? And you can start out just saying really well updated, very dated, needs 100K worth of work, just based on looking at it. Maybe they all need to be redone. And you want to get an idea of what the rental income is for that. So that starts to educate you on what is that market look like? What is the sale price? What should you be able to get for rents? Then you take that spreadsheet and you go look at for sale listings and you say, okay, the ones that are being marketed are going for about the same price per dollar of income or price per unit as these sold listings, or they're whatever price. You see whether those deals would actually meet your financial goals, right? I still tell people you want to make at least $200 a door per unit. And that's after banking, putting in maintenance, management, 6 to 10% management, depending on your market, at least 10% for maintenance, 10% for vacancy. If after a mortgage payment, you're left with $200 a door, you're not doing too bad. Now that's a very, baseline rule. There's lots of other things going into effect, but start there. So you become kind of a subject market expert and you see, is there anything in my backyard within an hour that can actually meet my financial goals? And if the answer is yes, then you start looking and you start making offers, in that market of other properties that are for sale that'll move the needle. Because what's going to happen is it's going to get you familiar with your market. As a new landlord, no matter how smart you are, you're going to be nervous as all get out to take that plunge and buy the first property. You're going to want to drive by it. You're going to want to see if your tenants put a couch on the front porch, or if they're, there's beer cans all over the ground, or if they're smoking, like you want to be able to see that property and touch and feel it. Most people just like to be able to do that. And if there's an emergency, hopefully you're paying a management company to do it instead of trying to self-manage, at least in the beginning. And, you when they call, you have a good idea of what's going on. So that's what I would do first. And then if that market really has absolutely nothing that can meet your financial goals, you still keep looking in your market because you want to build where you are. But then you take the same exercise you did in your local market and you start looking at the closest location to your local market outside of that hour that actually can produce, I'm going to say, cash flow, because I think everybody should at least have some cash flow and not be negative cash flow with an alligator starting out.
Yeah, I love all of that. The only thing I would add on top of that is I'll try to give Nicholas some kind of date ranges, because I think that was so well said. I think real estate investing is a skill. I think it is easiest to learn the skill in your backyard. So again, driving around, doing all of that. And one wrinkle I would add to that is maybe try to meet 2 new people a week in your market, real estate agents, brokers, other investors, because again, It is a people business. So I would probably spend somewhere between 30 and 45 days kind of in the area. And the goal at the end of, let's say, 45 days is to go, okay, this is going to be my buy box, which will be a subset of the bigger market. Then to your point, or whatnot, just like you described, then I would spend probably 3 to 6 months gathering all the data you talked about, what was sold, what's new listed, what went pending, what came back, kind of just the engine of that. Again, meeting 2 new people every week, figure out what stuff's renting for, what costs are, get, GCs and contractors so you can get, scope. And at the end of a total of 6 to maybe 9 months, you're going to know, is this a place I need to stay? Or do I take my refined skill, because you've just spent 9 months learning the skill, to a location that's an hour and a half, 2 hours away? So I think all of that is just wonderful, wonderful advice.
Yeah. And Michael, I would just add one thing to your point about meeting new people. There's a lot of local investor meetup groups that you can find on meetup.com, or actually go out on Facebook and look at, for example, Central Pennsylvania real estate investors, and you'll be able to see where there are meetups of other investors. And typically in those meetups, you're going to find, flippers, wholesalers, lenders, landlords. You're going to find people that do everything. You're going to find realtors there. And so start going to those local meetups. And that's a really good place to find investor friendly partners that are in different fields, as well as other investors that can point you in the right direction.
Awesome. All right, we're going to go to, I hope I'm pronouncing this at least close to correct. Olgaza. Hopefully I'm close. If I missed it, I apologize. But here is her comment/question. Got inspired by Michael Zuber's speech about fire your friends. The investing journey can be lonely sometimes. And I feel like the moments like this, everyone needs a friend to share the overwhelming moments we are going through, the wins, the losses, et cetera, et cetera. So talk about the importance of really building a community of like-minded individuals that are supportive and helpful versus maybe the friends who through no fault of their own don't understand.
Yeah. This is important. But I think we have to be careful, right? Because there are friends in our lives that are there that we might not have real estate in common, but who may be some of the best people for us and the best relationships for us because they know who we are and they love who we are without judgment. Hopefully we've all got a friend or two in that category. And so, I'm a little cautious sometimes when people say, I know Jim Rohn says you're kind of the average of the 5 people that you spend time with. And so you want to make sure you have friends in the business who understand what you're going through as a new investor or as an experienced investor, who can relate to you, who you can share thoughts with, concerns with, challenges with, that look at you with some level of compassion and understanding instead of thinking, oh, all you care about is money and accumulating things. Because there will be people that maybe were your friends who don't have any money that start to look at you and kind of judge you and compare instead of being there for you. So it's important to find new friends in the space. But I'm really cautious about people that say, I'm just going to fire my friends because they're not on the same page as me about money. I think if your friends are bringing you down, if they're judging you when you talk to them about those things and they're not staying that true friend, then yes, you can kind of reevaluate those relationships. But I think it's important to have friends from every season of life and every walk of life that you can count on, and you will be there for them at all times. And so don't be so quick to fire friends unless that the relationship really isn't good for you anymore and they're not growing, coming alongside you as you're growing. But those meetup groups, like we talked about in the first question, they're really important. And some of my really good friends in real estate are actually not, the big gurus and speakers that I, spend a lot of time with on stages necessarily. They're some of the investors, the realtors, in my backyard, the lenders in my backyard, because we have that local community together. We get together fairly frequently, even if it's a monthly meetup group. And so you really do get to know people who are like-minded and will encourage you along your journey.
I completely disagree. This is an area where we disagree. And again, I say this with a heart. There is absolutely value and history with having friends that go back decades and all of that. I can honestly say I have none of those. I don't have any.
Michael, I'm going to sound sexist, and I don't care. You're a guy. You're a guy. And I will say,
yes, I am.
I will say, listen, I follow counselors and psychologists and, different things, which I never really did. But, there's things that I have questions about, like, our upbringing and our backgrounds and relationships and all kinds of things. And there really is a big difference in men and women, generally speaking. Of course, we're all unique and there's exceptions, but men don't seem to have the same level of need of close, really bonded friendships who we feel like we can pour our souls out to. Men tend to be a little more surfacey and shallow in relationships than women are. It's a fact. So I'm going to sound sexist, but I think there is a difference for you as a male, Michael, that gives you a different perspective in what you need from friendships as a guy and what guys tend to give each other versus the bond and the need for that companionship and depth of knowing our souls that women do. So I'm sorry, I'm picking on you, but I think it's an important distinction.
No, and that's why we're here, because we know and respect each other, and we can disagree, which happens. But I think about and again, my audience, again, if I look at my YouTube stats, is pretty shocking. It's 88% male and only 12% female. So
Wow.
I am disappointed in that. Let's be clear. But again, typically the audience is the content creator. So,
Yeah.
I'm a guy to your, as you pointed out, there's no question about that. But again, I think about the person starting out, and I think about myself again, starting out. I was operating in a world at 30 years of age where I was spending every penny that came in. That was the world I knew. That was my friendship. And, I decided that I wanted a better future. I saw no other way of hitting a better future than making a clean break from the environment I was in. Because again, the friends that I had at that point, they kept doing what they were doing, and I wasn't going to participate. I wasn't going to take, the expensive dinner or the 3-day weekend or whatever that costs money. I was just out. The other thing I think about is when you try to make a leap from, a failed stock market investor to a beginning real estate investor, if you don't purposefully try to find those 5 friends or contacts in that new space, you're not going to get anywhere. You're the worst case, you're going to be trudging in mud, right? The faster you can get around other people doing the thing you want to do, whether it's real estate, getting healthy, having a great relationship, finding God, whatever it is, you can't do it with the old people. You got to do it with the new people. If you want to, start the journey, have success, and then reconnect with folks from your past, great. But there is no better way to accelerate and kickstart than to get around new people. And again, maybe that's a male-oriented view, but it is the one I have.
No, I agree with that part. I just think we need to be careful on the, being too quick to let other relationships go just because they don't serve what we want to create in terms of success and wealth. Because some friends, I hope we all can have a time in our life, at least have a friend or two, that are friends for life. So that,
I don't know what that feels like.
We have to make some new connections for sure, especially if you're moving into a new area. But without those at least connections, they're all going to start out as acquaintances, but make a point to take them to lunch, not just, hey, can I pick your brain and buy you a cup of coffee? No, I'd like to get to know you. I'm new to the space. Do you have the time and the bandwidth for me to take you to dinner? And if not, maybe we can meet 30 minutes before the meetup and have coffee, but connect with acquaintances and make that point. You said, I think it was in our first question today, meet 2 new people a week, right? So I agree with you 100%. It would be very, very difficult. And I tried it and I had some success because I'm a driven person. I'm determined, even before I made local connections. But when I was in kind of a funk after the GFC and couldn't find lenders to say yes and didn't know how to expand when all the lenders said no, it wasn't until I went to a meetup group that I learned, wow, there's investors that are doing it differently. They don't need a bank. They really are using private money or seller financing. And so getting around those people to open my eyes to what I didn't know was so valuable to me to be able to continue and then have significantly more success down the road. And I developed some really good friendships with those people as well.
Love it. Love it. Let's go to a question or a comment from Harriet. Making disrespectful offers. Hi, everyone. Any advice on finding realtors willing to make disrespectful offers? And I'll just put some numbers around this so we're talking about it. Let's call a disrespectful offer 25 to 30% below list price as a target. So how do you find agents willing to do that for you?
I think it's very similar, to before. You've got to know agents and you have to know investor-friendly agents. And so, if you don't, you need to start going to some meetup groups. You need to go in those Facebook groups, Central Pennsylvania and, real estate investors, or I keep saying Central Pennsylvania because that's where I am, or landlords. And then you ask them in the group, who are your favorite investor-friendly realtors? Who do you do business with? And you ask it in the meetup groups, you ask it in the, in the communities, and then you reach out to them because then you know that they're actually agents that investors are doing business with. And so referrals are so important in this space. And especially, if you're in a smaller area, if you're in a smaller town, because you have to be very, very careful. And I learned this the hard way when I moved from Houston, Texas to a little, two stop sign town. I'm exaggerating a little bit, but teeny tiny town, two lights and I don't know, 10 stop signs. Everybody knows everybody. So if you're this outsider coming in and you start out the gate with 25 to 30% off offers, and that doesn't ever happen there because there's low supply, high demand, those realtors are going to put a target on your back and they won't even respond to your offers. So you need to say, who are the investor-friendly realtors? And then you need to make an appointment with them and talk to them and say, where are the properties? I want to find a great deal. And that to me means a big discount, 20, 30% off. Where in our area or what type of property located on what streets or what condition are there properties that I'm going to be able to make disrespectful offers on and it fly and actually get deals done? And then tell me how you're doing it. And so you want to work with agents that are going to help you or give you a realistic view that, hey, you can't in this little town. There's way too much supply. There's no demand unless it's functionally obsolete. It's 100 years old. It's falling apart. But if you go 15 minutes on the other side of the railroad tracks, it's a little more depressed and you're going to find amazing deals there. And then they're going to take you to make those offers.
Yeah. I think the only thing I would add to that is, especially when you're starting out, is you got to communicate, right? I wouldn't just look at the MLS, find a property, write it for below. I'd want to talk to, again, back to my comment early in the episode, is you got to meet new people, right? Yeah. And in the beginning, those should be licensed real estate agents, right? They're going to be the gatekeeper. So I would just have conversations with them. I would tell every one of them up front, and I would ask them if they're comfortable. And then I would articulate, this is what I mean by doing the work, right? I have an automatic search or help me with a buy box. And I only want to look at properties 45 days on market or longer. I'm not going to waste your time with a first day listing.
Right.
I want to look at things that have had a price drop. I'm going to use technology or applications like PropStream. And I'm only going to offer on properties that are free and clear. So I'm going to give you a cash price and a seller financing price. You've got to show the agent that you're doing the work and you are coming informed. And I've never met an agent, if you don't educate them on what you're doing, you're like, okay, I get it. And again, I told a story about an agent named Scott that I worked with in, I think it was 2020. It might have been 21. No, it was actually before that. It was 18 and 19 when I was flipping properties. I told Scott, I'm doing this thing called buying slumlord properties and creating pride of ownership rentals. Right? I talked about it in my first book, One Rental at a Time. We flipped 55 slumlord properties. So I told him what I was looking for, right? Total slumlord, disgusting, all of that, long on the market. But Scott, I'm going to be offering 30 to 40% below list price. Mm-hmm. Scott was aware of this. Scott at the time happened to be a relatively new agent who was trying to get my business. So I gave him a shot. He told me one time we wrote 87 offers before we got our first deal.
Wow.
Now, a lot of you think that took Scott a long time, but it took Scott like 90 seconds because all of my offers were the same. The only thing he had to change was the address, the APN number, and the purchase price. Mm-hmm. Everything else was the same, right? That was my deal. So he just created a template and, changed 3 variables and we sent them off. The long story short, 87 offers. We ended up buying 3 or 4 properties together, and I let Scott get the other side of the transaction. So Scott got 8 sides, right? He bought 4 on the purchase and 4 on the sell. So again, have conversations. Tell them what you're going to do. Show them you're an informed investor. Don't be, I'm an investor and try to flex your pocketbook and write 10 offers like a shotgun. Be informed. Do the work.
Absolutely. And 2 things. One, I'll add because it was the next thing I was going to say, and you mentioned it, is don't get stuck on I have to get 30 to 40% off. You need to go back to what are your goals for the property? What are your financial goals? And sometimes you might be in a market where that's just not going to fly because there's so much pent up demand, and everything is going for more than that. You might have to say, okay, my disrespectful offer might be actually a creative finance deal. So to your point of, properties that are free and clear, if hey, I can do cash, I have a private money lender, and you tell the agent, I want to do cash and it's going to be 30% off or whatever, but I can go closer to retail if they'll consider seller financing. Here's the benefits to the seller. Here's what I want you to put in the notes on the contract of the benefits to the seller or in the email that you send if they choose this route. And you're going to put in, this is a well-qualified buyer. They're not doing seller finance because they don't have money or credit. They just can get closer to your price if we can make it a win-win on the terms. And so it used to be that, when I came into this town in, 2007, I tried to submit some seller finance deals. The agents laughed at me like, you aren't from around here, are you?
You're from Texas.
We just don't do that around here. And I was like, I don't care if you do it or not. This is what I'm going to do. And so let me educate you on why. And then, you need an investor-friendly realtor that's going to then educate the seller on why creative deals really are a win-win, so that you take out of your mind, I'm scared because I'm making disrespectful offers and I'm getting there. They're not disrespectful offers. They're offers that can create a win-win if your agent is willing to educate the seller and the agent on why it's a win-win. And just shifting that mindset, even though we call it disrespectful offers, I find helps people actually have the confidence to do it, because you're like, how can we make this a win-win and get this deal done in a creative way that might not have been acceptable in the past, but it's going to help me move the needle.
Yeah. And again, I just love putting numbers on this. In that conversation, I love writing 2 offers when I know the property is free and clear.
Yes.
Again, I go to the agent, go, hey, here's my cash price. I don't know, say it's 200 grand, and tell them the reason it's 200 grand is because this capital is going to cost me 12%.
Yeah.
But I can offer 250 if the seller is willing to carry a big note, because they're going to charge me 6. Right. I'm a buy and hold investor that wants to own it forever. I only care about cash flow. Yes. Right. So what's important to the seller? Do they want all the cash today because they want to go out and blow it? Or do they take a little cash today and take a long-term note? These are, to your point, I use disrespectful offers because it's catchy and it causes people to go, oh, but if it's an informed offer, it's an educated offer.
Absolutely.
So, do the work. So this next one came from a DM. So it was a DM on the school community. People can send me questions there directly. And the net of the question was, Michael, you sold all your houses in 2005 and 6. Why aren't you selling today? So again, I'll answer from my perspective. But again, you've lived through the GFC. The general tone of the question is, hey, you sold last time we were at these affordability scales. Why aren't you selling this time? So do you see any difference?
You said you were going first, but I'll play.
You'll play? You'll go first.
I'm teasing. I think it's a very different time than it is, before the GFC. Now, with that said, I was concerned, that in certain markets, there are definitely properties that were going for way more than what they would cash flow with, even if you had, an interest only payment. And so I sold a lot of properties in the last couple of years that I thought were just way over the price that would allow you to cash flow. When, especially like a multi-unit. So like I owned a whole bunch of 4 units. I got my start on 4-unit properties. And when they were going at prices, Michael, where even with almost, even with 3% interest rates, they were not cash flowing. I knew they were not, and the rent to purchase price difference in that payment was already so close to where someone could own a home that the likelihood you were going to have renters be able to stay and cash flow and push those rents was just not very likely. So I saw the writing on the wall for certain properties that they no longer make sense for investors. And my end buyer is always going to be an investor. So let me sell today. And then I took that cash and I used it to upgrade my properties, to buy nicer, newer multi-unit properties in the same market at the low interest rate. So I've already kind of done that in the last couple of years. There's a big difference between single family and multifamily. Different types of real estate, we have different issues, right? So multi-units, you can't sell right now if they're large multi, and get your price and get, a good price for the income that they generate, because interest rates went up, cap rates went up, which means commercial real estate values fall on paper, but my things are cash flowing like crazy and I have a ton of equity. So I wouldn't sell today because I'd have to sell at a price that isn't worth the inherent value that they are to me. So I'm buying instead of selling more when it comes to, if I can find, a good deal, multi-units. Single family, we get this fear, and there are, the crash bros that say values are going to plummet. It's so unaffordable that we have no choice, but values are going to fall back to, kind of where the median income can afford. But the reality is we still have a housing shortage in this country, and there is still a lot of demand on the sidelines and not a ton of supply. Now you have different markets. And so again, places like Florida, California, parts of Texas where insurance has gone crazy and where taxes have gone up, you have a big increase of supply, and that is bringing values down a little bit. But in most markets, we have kind of an even market, buyers and sellers. Prices across the country are actually going up about 2 or 3%, with some exceptions and outliers. And so I don't think we're at a top like 06, 07, where suddenly you're going to have a big crash in values. We don't have the supply drivers to cause enough people to have to list because of financial crisis, that you have oversupply across the country. And you need that in order for prices to dramatically fall. Right now, we have locked in supply. People don't need to move. 85% of homeowners have mortgage rates below, I think, 40%. I think we said last week it was not close to 95% have rates below 5%. And so people want to stay in their homes. And as long as you don't have an increase of supply nationwide, you're not going to have a crash in value. So I'm not going to sell properties that cash flow or having mortgage pay down and have equity in a time where I'm not going to just make a killing on my sales price. I'm going to keep them because I can't find anything else to buy with the money. That's the thing. Like, is there enough stress right now that if I sold the properties, I can make as good of a return as what I'm getting on these properties I own? The answer is no, which is why you don't see a lot of multi-units for sale, as long as there's not distress because of the debt that's on the properties.
Yeah. When I go back, and I get this question quite a bit, because it was one of those critical decisions. It was kind of one of those timeline moments. I made a choice, and the outcome was going to be vastly different. So why did we sell in 06? Well, the first answer is I didn't have a plan. That wasn't my plan. I went to a real estate meetup. Actually, this was a paid meetup, or speaker, Bruce Norris, who was long thought to be a real estate expert, especially around data. At the time, he'd been investing for about 30 years. It's now 50 years. Mm-hmm. And he made some very good historical calls. And he was publishing a report called The California Crash. Obviously, as a California investor, that caught my attention. And as somebody who suffered an 80% loss in the stock market, I was going to that meeting. Yeah. So I go to that meeting. It's 3 or 4 hours long. He goes over what was probably 500 charts. But what I take from that whole session was one concept called the affordability index. Something I had never heard of, never thought of. I had read 100 books or more by that point, books back to the 80s. Nobody had ever talked about it. So I said, okay, I got to go figure out the affordability index. Thankfully, at the time, it was published monthly by the National Association of Realtors. So I could go back and look at the last, I think, 20 years or 30 years of the affordability index. And what we found was it was at a record low for my MSA of Fresno, California. And you can go back and look at history. Other times it had gotten that low and see what happened to price. So the first step was I went to an event with a known expert. I paid to be there. I took one thing away. I validated it, and then Olivia and I took action. We listed all of our houses, and we sold them, and then we 1031 them into apartment buildings, which really worked out well for us. And again, I had no plan. My plan was 4 single-family homes. I didn't want to own multifamily. I didn't even think you could own multifamily. I was like such a novice. But that was the first step. So now, why am I not selling today? Well, step one is the affordability level is bad, but it is nowhere near where we were in 05 and 06. It's not even close because wages are up. Fresno County has seen a lot of kind of, LA and Silicon Valley money move there, right? So wages are up, right? So the affordability is not nearly as bad. Second, something I have learned, because again, when Bruce Norris helps you out, you pay to go to Bruce Norris events. So I went to a Bruce Norris event about a year ago because I'm like, hey, affordability is getting worse. What is Bruce Norris saying? So again, paid to be in the event. This time was more money. And he's basically like, we don't have the same setup. We don't have adjustable rate mortgages, right? The reason the last time got bad was all of these arms were resetting and exploding higher, which just caused the inventory to seemingly never stop. Right. In those years, we were seeing something like 250 to 300,000 new listings a week.
Wow.
Today it's 56,000. Right. It's just in a completely different supply picture.
Mm-hmm.
Today we have 95% of loans 30-year fixed. As you say, 80 or 85% below 4 or 5. I mean, it's not the same setup. We're not going to have that wave of supply after supply after supply. We're not going to have a race to the bottom. And then the last thing Bruce Norris and I have seen and I've talked about is banks will simply not repeat what happened last time.
Right.
Even if we have the crazy setup and unemployment goes to 10%, banks are not going to be foreclosing on people en masse. In the last cycle, if you got 90 days late, you were more than 95% chance you're going to lose the home, which means roughly 5% of people would work it out. Did we not learn anything from the pandemic? They are going to give you forbearance. They're going to give you workouts. They're going to take silent. The banks are just going to act different. Again, reducing the stress. Now, to be clear, we will have distress sales. There will be unfortunate situations where it can't be saved, but it is not going to be the massive wave after wave after wave after wave after wave. It's just not coming.
Absolutely. Absolutely. And the interest rate lock-in effect cannot be understated. I mean, it is a huge issue. People before, because of the variable rate interest and because they were losing jobs, because lots of companies were failing during the GFC, had to sell. Right now, yes, we have an uptick in layoffs. We're seeing it. We've talked about it multiple times on the show, but not yet to the level that it's crisis mode. And many jobs. I don't know the exact percentage, Michael, but we're in a remote work kind of environment now. So many jobs now, if people do lose their job, they're going to go on unemployment and they're going to find another job, maybe without having to move. And that's going to, vary based on your industry that you're in and based on your local real estate market and where people work in those areas. So it's important to be in areas that have a lot of job diversification. But while you may have some pockets of sectors and some areas that do start to see a real increase in supply and values fall, that's where we as investors go and say, that's our opportunity to buy there, right? But unless you have that, nationwide, we're not going to have this huge supply wave that we had before that really is what's needed. It all comes down to supply and demand, to crash prices. There's still enough people and, with government programs to make getting into a house easier. And I think there's going to be more of those programs. So yes, prices are higher, but if you can get in with no down payment, like you can in a USDA loan, or 3.5% like FHA, and incentives for first-time home buyers to give you down payment assistance, et cetera, I think you're going to kind of allow people to get into homes, even if interest rates don't fall substantially, with less money down, which is going to help some people.
Yeah, I love all of that. We're going to take a quick right turn. There's 2 other concepts I want to just throw at you. One of them was a price forecast from Apollo Global Management, I believe is the name of the group. Again, I want to shout out Lance Lambert, owner of Resi Club. I follow him on X. He's my Thursday guest. So this is Lance Lambert. So he's actively collecting 2025 price forecasts from all of the experts. Most of them have somewhere between 1 and 4.5% for 2025, except Apollo Global Management.
1 and 4.5% for what?
Price appreciation, median home price appreciation for 2025. Yeah, 2025. Apollo Global Management is forecasting 10.8% home price appreciation in 2025. How's that feel?
I think it's wishful thinking. Now, I don't know his data, but I don't believe prices are going to go up 10%.
Not nationally.
Not nationally. Again, it depends on the area and the market, but a lot of it depends on whether a recession is declared and where long-term interest rates go. And long-term interest rates, I thought, would come down precipitously. I mean, I think that's what we all kind of thought. It's what the Fed was saying once inflation is kind of handled. However, a lot of what needs to be done and what our new administration is saying they're going to do, we've talked about this, so we won't belabor the point, but is inflationary, at least in the short term, right? And that may keep Treasury yields up, regardless of if the Fed cuts rates this month and going into next year. So we got to look at that long-term Treasury rate. Unless rates fall, I'm going to say to 5% or less, I don't think you're going to have a huge unlocking of demand. And if the economy starts to falter and we actually do see this recession declared and materialize and more layoffs in 2025, that's going to cause less demand for housing, even if rates come down a little bit. So let's just say we have a status quo and that 2025 long-term treasuries are kind of where they are. We don't have mass layoffs and we just kind of continue stagnating like we are. There is definitely demand on the sidelines, and that's going to mean that more people are going to want to buy homes than we have sellers selling in most markets because of that lock-in effect, and that's going to cause price appreciation for sure. But I think we would need so much more demand to get to 10% appreciation, and that demand has to be unlocked by something. It's either a booming economy with inflation coming down, and we see inflation's actually ticking up a little bit and might more, or it's a big drop in the 30-year fixed mortgage that's going to unlock that. And I don't see that big drop coming unless we have, something that we're not seeing, another surprise, thing in the economy. I think it's going to be kind of status quo, more of the same over the next year when it comes to demand for single family homes. So I don't see where they're going to go up 10%. And I'm conservative, Michael. So I really say, I'm aggressive enough that I've done really well and continue to do well, but I'm conservative enough to say I don't buy for appreciation. And I don't think most of us should buy for appreciation. Now, if you're very, very young and you can afford negative cash flow on single family homes for a while as investments, more power to you if you're banking on appreciation. But I've learned, and kind of like your first book, you don't buy the alligator property that's going to cause you to go in the hole every month. You need something that cash flows. And so if you're buying for cash flow and you've got mortgage pay down, equity built up because of that monthly principal payment, then the appreciation is the cherry on the top. But where I see a lot of people get in trouble, Michael, is it's okay if I negative cash flow a couple $100 a month. I'm never going to have vacancies, but I'm going to have 10% appreciation next year. And then they get hurt because their tenants move out. They have higher vacancy. They have higher maintenance costs. They're not cash flowing. And then that 10% that they read somewhere doesn't materialize. That's when they end up being a forced seller. So yep. I don't look at appreciation. When I'm doing my numbers, I'm like, you showed this. We did the chart back to the 1970s, over 50 years worth of data. Average home on an inflation adjusted basis goes up 1% per year, inflation adjusted. Exactly. So if you want to build something in, build in your 1% per year inflation in your total ROI. And if it's more, great. It's the icing on top. It's the cherry on top. But I just don't see it. So tell me where I'm wrong. How are they getting 10%?
First off, they're clearly the outlier. When I saw that, my response was, I hope not. And I hope not for several reasons. One is, if we rose another 10%, it would become at the expense of first-time home buyers, right? Who are already stretched. Historically speaking, first-time home buyers make up roughly 40% of the market. Today, they're 24. That's horrible.
Yeah. Right.
If we saw a pop of 10%, me a forced seller. That might be that extra 10% on top of this that makes it unaffordable. Back to, why I sold earlier. I don't want to see it. I would love the housing market to heal, which to me means flat, back to that 1%, 1.5%, which is my call for 2025.
Yeah.
We just need time to get through this.
Right.
When I think about, like, and people ask me, what would it take to get 10% increase in 2025? I think you kind of hit it, but I'll hit it again. It would take 5% mortgages. It would 5% mortgages, no recession, booming economy, 3% growth, tax reductions. We would have to go from feeling good about a 2.5% GDP growth to 3.5%, 4%. It would have to be a booming economy with 5% mortgage rates. That could get you 10%. I don't think that's coming, but if you want to put a gun to my head, that's how you get there.
Yeah, it's the only way you get there. Or you have it's hard to say, because recessions they're a double-edged sword. They can either really drop rates, and the people that aren't laid off are going to be really excited, and they're going to force prices up when you have low supply. But it could end up, if a recession was really, really bad, that's going to scare enough buyers away that the sellers that have to sell are going to, have to sell at a discount. So they can go both ways. But, even the 5% rate, I'm not sure. I think that's the minimum they'd have to get to really unlock. But you've got a lot of buyers who have just said, you know what, right now, where prices are, and even at a 5% interest rate, it's actually cheaper in some areas to rent by a lot. So I think some buyers just end up saying, hey, I'm going to save up more, and I'm going to have a lower cost of living. And I do think that there is a big shift. We talked about it, on last week's show. So go back and listen to that if you didn't. But I think there's a big shift in the first-time buyer mindset. And a lot are no longer doing it in their 20s, their mid-30s for first time. They're renters by choice. And a lot of them don't want to be tied down to one place, one home, one market. They want to travel. They want to, make memories and not, have, the desire for home ownership, I think, is less than it was before. And they're having less kids. They don't need as big of a home, to buy. And so, it'll just be interesting to see how that plays out. But again, I think it's one of those things that keeps home prices from going up 10%, at least nationwide, as well as, the dynamics of the interest rates.
All right, last one. I actually heard Alex Hormozi say this the other day, and then I found a tweet where he referenced it as well. I want to see if this one hits for you as well. You ready?
Yes.
Rich people buy time. Poor people buy stuff. Ambitious people buy skills. Lazy people buy distractions.
Probably pretty accurate.
Yeah, I was running when I heard that. I had to stop. I'm like, did I hear that right? Rewind. Yeah. I mean, it's
rich people buy time.
Buy time.
Poor people buy stuff. Ambitious people buy skills.
And lazy people buy distractions.
Yeah, I think that's pretty accurate.
All right, Alex Hormozi, you've got the one and only Anna Kelly's blessing. Anna, where can people find you?
Great. You can find me on social media at Anna Kelly REI Mom, and for real estate coaching, consulting, and potentially investment opportunities for accredited investors, you can find me at my website at annakellyinvesting.com.
Anna, you're amazing. Thank you so much.
Thank you.